Hey all, I'm Alex Martin. I'm an accountant and I help businesses solve financial problems. Pretty much what an accountant is. So let's dive right into this. If you run an ad agency, you are in great company with Simone because she sent us an email and she said that last year was her best year, billing $1.2 million, and she took a draw in December, meaning she took cash out of the business on top of her actual salary, kind of like as a bonus distribution to the owner. And that's totally fair because she's kicking ass. And in January, she had to use a credit card to pay 30K for payroll, which is bad because she didn't have the cash in her business to afford that. And payroll is one of those expenses where when it comes due, at least here in the US, you have to pay it, or they'll sue you for all you got. But her bookkeeper says her margins are actually looking pretty healthy at 62%, so she's not really understanding where all this cash went. And her friend asked if she knew what her margin of net pass through was, and looks like she doesn't, so we're going to explain that here. And if you don't know what margin of net pass through is, it's essentially how much you have after client ad spend, meaning this earned amount right here for $900,000. And to get that number, we take the billed amount, subtract the client ad spend. This is what the clients gave us to book their ads. Think of it like a contractor where they will come into your house to fix your air conditioner, whatever, and they'll bill you $1,000 for the parts and an extra $1,000 for their service fee. So it's a pretty standard model. Taking a look at it, her gross margin on these two numbers vary dramatically. She thought she had 768K as her gross profit, but it was actually a lot less at 558 because this client ad spend up here does not belong to her, meaning that 210 of these dollars does not belong to her and did not hit cash. Now, another issue she has on her books is that she did work in Q4, October, November, and December, but the bill for that work didn't show up till December and January. This happens often when you hire contractors. The bill will come a lot later because they need to book the time that actually took place. So 40,000 of this ended up in these months, and what she actually should have done is expensed it in this period right here and set aside that cash so she could cover this and factor that into the draw so she doesn't overdraw. So moral of the story here, book your expenses when they happen because in addition to missing out on this 40K that was not rightfully hers, she missed out on a tax break because she wouldn't have been taxed on this $40,000 if it was captured in the correct period because that money was used to fund business operations. Another issue she had is her accounts receivable, and this is pretty common among a lot of business owners, is that this is cash that she doesn't actually have in her bank yet. That's because accounts receivable, you recognize the revenue, the top line, but you don't collect the cash until later. So you got to get it through your head as a business owner that revenue doesn't exactly translate to cash. You need to pull out a bunch of items before you can get that number. And on top of it, too, she has pretty high credit terms at net 45, pretty generous. So what this means is the client has 30 days to pay the bill or 45 days to pay the bill. Now you can alter these and make them shorter, or you can do a discount for the first 10 days at like 2%. And even though you're collecting less cash, you are basically guaranteed to collect the cash. Otherwise, there's still a high chance this 50K could never be collected and she'd just have to write it off. And for those of you who think, oh yeah, write off's a good thing, write offs are not always a good thing, especially if you're losing cash. So don't be that idiot who wants to write everything off. Capture expenses, not write offs. Next, we're going to move on to this draw sheet, which kind of tells us the story of the cash. And we talked about net revenue up above of 900K. This was how much she spent for the ads from the clients. And here are her contractor and direct cost. This is how much it actually cost her to deliver the service to the client. That leads us to gross profit. After that, though, that's not the cash that she can take out. That's the number she was probably looking at. She has to take out operating expenses first, and then that gets you your operating income. And she may have even been looking at this number, but we're not done yet. We still have accounts receivable, which we haven't collected yet. We have the contractor costs that we have to pay coming up in January, and that gets us the actual cash available. But she also forgot in her calculations to include her personal salary, leaving us with only $43,700. And now we can actually see how much she took out, 45K, which leaves us at a deficit in the business. She actually owes the business this money since she overdrew. And the bank's probably charging you a fee too, so maybe add to that. But moral of the story here is when you're taking a draw from your cash, you got to look at how much cash you actually have after everything's applied. She wasn't looking at this 43,000 number. She may have been looking at this, maybe this one that also seems very high, but she was probably looking at this number right here. Honestly, I probably would have taken out more if I was her looking at this number, but she kind of fucked up, and that sucks because this can impact her whole business for the rest of the year. Now, 3 ways she can fix this problem is booking her cost when the work happens. That's recognizing the expense in the period in which they occur. And then you measure your cash after accounts receivable, not gross profit. Because this accounts receivable is money that you do not have. You are legally owed it, but it's never guaranteed to collect it. It's like when you go to 7-Eleven or lunch with your friends from high school and they said, "Yeah, yay, sure, I'll pay you back." You graduate from college and they still owe you that 20 bucks. So factor your cash after accounts receivable and not before. And this is a nifty one. I would change your credit terms to collect 50% upfront. If not, I would collect however much money it costs to deliver the service to the client. Meaning I would collect that $340 to deliver the client services up front. So you're never funding client work with your own money, and you should never be funding client work with your own money if your business is at a high enough level to sustain that. So if you run an ad agency or any business for that matter, I would make sure you would check your books because you could have revenue that's overstated. You could have costs that you owe but which haven't been recorded yet. You could have accounts receivable that when you calculate for your draw, you believe that money's already there. So you need to take that accounts receivable out before you calculate how much you will have after you draw. Then I would consider any operating expenses that you still have to pay. And the moral of the story, don't draw against the wrong number. You guys can be smart, but there can always be a disconnect between you and the accountants. Us accountants don't expect you to know everything because that's what we are. We translate numbers to help you make financial decisions for your business. I'll be making more of these types of videos. If you like it, please let me know. If you have any questions, please leave a comment. I might be able to answer it. And follow for more practical advice.